Bill, talk to me a little bit about how do the trade tensions actually affect your business?
Yeah, so far, not so much, and we're hopeful that continues for some time. But for us, the U.S. China trade is a relatively small proportion of our overall income. But let's keep in mind that the trade hasn't actually reduced very materially between U.S. and China, and trade within the Asian region is still very strong. We could say even that the more the tensions go up between U.S. and China, the more the trade between China and the rest of the region will increase, both because the Chinese goods are going to find an outlet, but also because the supply chains are being reconfigured. So more and more of the investment from international companies who are eventually exporting back to the U.S. is being rooted outside of China, but also Chinese companies are rooting their supply chain outside of China in order to avoid the impact of sanctions overall. Given that we operate in every Asian country, in every South Asian country, in 11 countries in Africa, across the Middle East, and another 15 countries across the region from an offshore perspective, these are our markets. And as these supply chains reconfigure, this should be a good thing for us in the medium to long term. And in the short term, of course, we're all very concerned about how this trade tension escalates.
But you're still confident that you are able to deliver this 5 to 7% income growth over the next 3 years, right?
We are.
So it doesn't actually impact anything right now.
Yeah, we're going to watch very carefully at the economic impact of these rising tensions. So we feel a sluggishness and an overall heaviness in the global economy right now. Some of that is cyclical. Maybe it was going to happen otherwise. Some of that is on the back of concerns that these trade tensions or technology tensions could become much more severe. So the economic impact is real. We're seeing signs of that. In terms of the flow of trade, it's going to change, most likely, on the back of this escalation, but not necessarily in a bad way for us.
How do you see the world economy right now? Or do you worry about a downturn, or is it wait-and-see mode?
Well, we're always worried. I mean, I think we're paid to worry, but I do worry about the heaviness in the world economy right now. We're seeing downgrades consistently. Various estimations from our economists, from other economists around the impact of a further escalation in U.S. China tensions, and you're looking at global economic growth now that's below potential in terms of forecasts for the first time in a few years. Chinese growth is feeling a bit of pressure, and U.S. growth is showing some signs. The consumer is very strong, which is good. Let's be clear, the U.S. economy is still very strong, but there's a pressure. And a downward pressure that wasn't there even 2 or 3 months ago.
How does that change your job and what you're focusing on for the bank?
We're building our bank for the long term. We're extremely well capitalized. We're very liquid. We're investing quite heavily in a number of themes. We're betting on the ongoing opening up of China, which is happening. It's happening from day to day. Now, the opening up may be directed more at other parts of Asia and less at the U.S., depending on how things unfold. We're still hopeful that there's a resolution to the U.S. China tensions. But on the assumption that there's not, which is the base case, I think we have to say that's the base case, then we're focusing on how this very important Chinese economic machine is directing itself at the rest of Asia, the Middle East, and Africa, which are our core markets.